Welcome back. In today's video, I will show you how my long-term approach to investing with Fundrise rewarded me with massive returns over the past 2 years. I will also argue that even though investing through dividend portfolios is a viable strategy, it doesn't really compete with the long-term profits that Fundrise offers through appreciation. Coming up. If you're new to the channel, my name is Trey and I have over $545,000 invested in stocks, crypto, and real estate. If you enjoyed this video, make sure to check out my entire Fundrise playlist linked in the description below. It has over 40 videos on everything and anything you need to know before, during, and after investing with Fundrise. Also, if you decide to invest with Fundrise for the first time, make sure to open a new account using my referral link linked in the description below. For a limited time only, Fundrise is giving $50 to anyone who opens a new account and deposits at least $10. Now, let's get started. So, the two ways that Fundrise investors get their hard-earned returns is with 1, dividends, and 2, appreciation. Now, last week I released a video about Fundrise dividend investing. So, check it out after you watch this video. The link is in the description below. Now, let's talk specifically about appreciation. Let's start off by defining appreciation as it relates to real estate. So, real estate appreciation is an increase in value of a certain property over a period of time. Okay, guys, that's it. Hey, the video's done. We're done. Let's go. Hey, let's go. Hey, thank you so much for watching, guys. Just joking. Here's an example. Let's say 2 years ago, I bought an old broken down property for $200,000 in an up-and-coming suburban neighborhood in New Jersey. The area has never been expensive, but due to recent migration of people from cities to the suburbs and the new work from home concept, this area has seen a drastic increase in demand. Therefore, the price of this property has increased by 25% in just 2 years. This means that I would be able to sell it for around $250,000 today. This increase in intrinsic value of a property over a 2-year period is called appreciation. What if instead of selling it for $250,000 right away, I decided to take just 6 months and fully renovate it? After all, I did my research and I know that folks that are moving from the cities have higher salaries and generally are willing to pay for a new, fully renovated, and more expensive high-end designs. So I do just that, and now I'm able to sell this property for $400,000 after all the renovations were done. This increase in value of a property is also called appreciation. However, it is important to note that this works the other way as well. So, if the neighborhood declines, or I decide to sell the property with broken down siding or leaky roof, then the value will decrease from $200,000 to, let's say, $150,000. This is called depreciation of a real estate property. So from this example, it could then be concluded that real estate appreciation is an unrealized increase in value of a property. What do I mean by unrealized? When I say unrealized, it means that even though the value of your property increased or decreased, it only increased on paper, and you can't physically use this profit until you sell the property. The price of the property can fluctuate up or down until you lock in your appreciation profit by selling that property. When you sell the property, you actually realize your gains, and that is called a realized return or a realized profit. It is probably much easier to understand with an example. So let's go over one. Let's take a look at this example. You buy a property again for $200,000. Over the next 10 years, the neighborhood has seen high demand and you renovated the entire place with the best materials and the best designs out there. You even put some NFTs in the wall through a USB. You now see that the same property is worth $500,000 just 10 years later. However, you decide not to sell and wait a little bit longer, for example, until you retire. At year 13, however, the climate changes. A neighborhood now sees an increased number of floods and tornadoes on a yearly basis. The demand because of that starts to decrease, and people start moving out of the area to more hospitable environments. Out of nowhere, the value of your beautiful real estate that you put in these high-end products in decreases to just $300,000 because no one wants it. Being frustrated and disappointed and depressed, you finally want to cut your losses and you decide to finally sell the property at $300,000. As you can see, at year 10, you had a property that was worth $500,000. But because you failed to sell, this appreciation return you had was unrealized. Then, when you finally sold your property at $300,000, you realized your appreciation return. So it can't be concluded that returns from appreciation of real estate are volatile and will fluctuate from time to time until you sell and lock in your profits. This is entirely different from dividend returns, which once you receive them, they're yours and they are not going anywhere. Another way that appreciation returns are different from dividend returns is that dividend returns are acquired either from rental income or from collecting interest on a loan given to a land developer, as opposed to appreciation returns, which is an increase in intrinsic value of a property. At this point, you may be asking yourself, how does this relate to Fundrise investing? After all, when you invest with Fundrise, you don't directly own the real estate, right? And that is a good question. Let's take a look at one of my two Fundrise accounts. This account is about 2.5 years old. This is my main account. So as you can see, it has about $70,400 invested in it. And here you could see my all-time returns in this 2.5-year period. You could see the returns that I received in terms of dividends, which at all time are at about $1,300, and my returns from appreciation that are at around $12,000. So the first thing that I want to point out is that my returns from dividends are realized, locked in. These $1,300 are completely mine. They will not fluctuate up or down. However, my returns from appreciation are unrealized. So these $12,000 are unrealized. Therefore, they may fluctuate from time to time. I may log in tomorrow and this will say $11,000 or $15,000. So if you notice your portfolio increase or decrease in day-to-day or month-to-month value by relatively large amounts, that is due to changes in appreciation or depreciation of certain properties. The second thing to point out is that with Fundrise, you don't directly invest into properties. In fact, you invest into something called E-REITs or E-funds, which are baskets of different real estate properties owned by Fundrise. So let's take a closer look. What we're going to do is we're going to still use my main portfolio here. We're going to click on portfolio. Then we're going to click on real estate. So as you can see here, these are all the E-REIT and E-funds that I own in my Fundrise portfolio. Each one of these has a number of real estate properties inside of it. So let's pick everyone's favorite and the best performing E-fund of 2021. Yes, you guessed it, the flagship real estate fund. So what we're going to do, we're gonna click on here. And what we're gonna do is we're gonna scroll down just to start off. As you could see, all these properties here, single family rental, stabilized commercial, you keep scrolling down, there's actually 7 pages of this. These are all individual properties or complexes that are inside this flagship real estate fund. So this flagship fund has 57 projects inside of it. And you can learn more about each specific property by clicking on it. So let's say we pick this one, you could click on it, you click on view details, and you can learn everything you want to know, all the updates. Some of them even have a lot of pictures on them. So let's say this is the strategy that this certain project has, value add. What is a value add? I actually have a very detailed video about the different strategies that Fundrise utilizes with their projects, but just essentially this is when they pretty much bought a broken down old complex and they're gonna renovate it. Investment size, about $2.5 million, not too shabby, status is active. And what you can see here in orange is that the interval fund, which is another name for the flagship fund, is funding this project with $2.3 million, and the growth E-REIT 7 funds it with $250,000. They also have a project timeline. This actually, as it gets developed, renovated, rented, sold, this gets updated and you're gonna have a longer timeline. So now let's take a look at my position in this fund. So these E-funds and E-REITs are essentially like shares of a stock. You can buy a share of this E-fund just like you buy a share of an Apple or a Microsoft stock. So let's take a look at a few important numbers here that you wanna know. Okay, obviously the most important thing is over here, current NAV per share. And NAV stands for net asset value. So pretty much it's at $13.48, and this is the current price for one share of this flagship E-fund. So this NAV, or price per share, increases or decreases based on the increase or decrease in appreciation value of the 57 projects inside this specific fund. So the benefit of investing in E-funds and E-REITs is that they have a built-in diversification in them. Even if one or two of these 57 projects or properties in this E-fund lose value, the net asset value will not decrease by a lot. And your portfolio will not lose as much value as it would if you were to invest in those one or two properties directly, which is a great volatility reducer and a benefit to investing with Fundrise. Okay, so bear with me here. Here's a good example. So as of right now, the price per share of this flagship fund is $13.48. Let's say a month from now, the single family rental, any one of those 57, loses value due to some unforeseen circumstances. Because of that, the net asset value of this flagship fund will go down to, let's say, $13. It is important to know that Fundrise and in general private real estate markets don't fluctuate in price on day-to-day basis like a regular stock market, which gives you reduced volatility. So you're likely to see changes in the net asset value of an E-fund or an E-REIT around every 3 months when the quarterly results come out. So in order to realize your appreciation returns with Fundrise, you would actually have to sell your shares of a certain E-fund and an E-REIT. Until then, your appreciation return amounts may fluctuate. So finally here, you could see how many shares I own of this fund, which is 2,480 shares. And over here, you could see my estimated value of shares owned, which is pretty much the quantity of shares multiplied by the price per share. So this is my estimated value. Now, note that it says estimated value, and that is because this number can fluctuate for all the reasons that I just described in this video. And here you could see my total returns over here. You could see the returns from dividends. You could see the returns from appreciation. Lastly, I'm sure you noticed that my returns from appreciation over here are much higher than my dividend returns. And that is simply because I choose a long-term growth investment plan, which you could see right over here. This investment plan concentrates on investing your money into certain E-funds and E-REITs, which have more projects that will appreciate in value rather than generate rental or interest returning income. Long-term growth investment plan sacrifices short-term returns, but tends to outperform dividend-based investment plans such as income or balanced portfolios over a 5 to 10 year period. In other words, you will likely see higher returns from income-based and balanced investment plans in the first 1 to 3 years, but after that, the long-term growth will start outperforming in years 7 to 10 exponentially. Instead of the long-term growth, of course, if you so desire, you have a choice of choosing an income-based plan or balanced portfolios. Income-based plan will give most of your returns in terms of dividends, while balanced portfolios will be around 50-50 between dividends and appreciation. In conclusion, I believe that long-term growth investment plan is the best way to invest with Fundrise. If you're a young investor, far from retirement, and have a 5-year or more time horizon to invest, you will maximize your gains through appreciation. In addition, you will only pay capital gains taxes on your appreciation returns when you decide to sell, which is usually around 15%, unlike dividend returns, which get taxed as your ordinary income at your ordinary income tax bracket every single year, which are usually likely at 25% or higher. So this is it for me, guys, but I want to hear from you. What is your opinion on appreciation or dividend returns? And which portfolio are you choosing to invest in with Fundrise? Leave your comments down in the description below. I can't wait to hear from you. Thank you so much for watching. If you enjoyed this video, please don't forget to like and subscribe, and I will see you next time. Take care. Peace. We got a lot of great things coming to this channel in August. Take care.